All right, guys, welcome back to the channel. The reason why we do this channel so aggressively is because there's so many questions that come through the channel that have a common thread about them. One of those questions is how to invest a sum of money. I just had a question come through the channel. The subscriber was looking for some ideas on how they might go about investing $80,000. I get this question all the time, okay? And $80,000 is a large sum of money for anyone, but I think my answer may help a lot of different people out there that may be in the same camp, whether they have $100,000 or whether or not they have $1,000 to invest. I think the principles of entering some exposure into the stock market are relative in nature, okay? I think the deliberations should be somewhat the same, no matter what sum of money you're looking to start with in the market. But I'll take this for action, and we'll take this question, and I know the subscriber who asked the question will be appreciative of my just putting a video out there, because it will reach a lot more people looking to answer the exact same question, and I know people will benefit from the deliberation that I go through, okay? There's a lot of different things that you can surround that $80,000 with in way of strategic, fundamental approaches before you even get to that $80,000 and deploying it, okay? It's one of my strengths. I'm very, very good at taking any sum of money and kind of breaking it up into opportunities for investment. Now, what I was not provided with, which is very, very commonplace when I get asked this question, is what age are you? What type of investment time horizon are you looking at? What type of investment are you looking at? You know, if your goal is to buy a house in 5 to 10 years and you want to save for a down payment, obviously the stock market is one way of investing, okay? But it's not the only way. If you're looking to save for a child's college education, obviously the route there is different to seek your exposure to meet that end, okay? So having some idea in answering why it is you're investing the money in the first place and what you're looking to get out of it is super, super important. And what comes with that financial goal or goals that are attached to that money, $80,000 is enough really to meet a lot of different strategic goals and piece that money up into a way that can meet a number of different goals. Safeguarding, getting some exposure to some higher risk depending on the age. We may look to put some of that money into some fixed income for the individual investor. Obviously cash is one of my favorite ways of making a buffer there, because if you're totally over levered to the market, you don't have any money put away for an emergency fund. I really think that can set you up for some problems going forward. So once you have an idea of the risk tolerance and the goals, and these are super fun to determine, guys. This is not work. This is so much fun. This is stepping into a different world of controlling your money and not allowing your money to control you. Determining your risk tolerance and your financial goals really is the start to something so much greater in your life when you start to deliberate and answer those questions for yourself. And it is in fact relative, no matter what amount of money you're working with. But once you have those two things identified, the next two things you're going to want to identify is what account you're interested in, okay? This is where we start to deliberate across the landscape on what broker you may be looking to go with. Perhaps maybe you have your existing accounts with JP Chase. Perhaps maybe you have your existing accounts with Bank of America, Fidelity, TD Ameritrade, and down the line, okay? Now, if you have the majority of your accounts with those, or you have the account established, wonderful. If you don't, you're going to need to do a little bit of homework on your end to say whether or not a TD Ameritrade or a Charles Schwab would be conducive to your needs. Now, I would caution each and every viewer of this video not to overblow this, okay? The landscape in investing has changed so much in 2019 that becoming an investor is super, super exciting. There's so many different incentives. You can invest in the market free of charge, really. You have unlimited free trades to access. It really just kind of comes down to the aesthetics of the platform that exist. And what aesthetics on that platform are going to give you the best shot at the data and analytics that you seek out, okay? So that's the first thing, is to determine that account. Who is going to be the broker that is going to be potentially housing this money through a tax-deferred individual retirement account, which you guys know is my very favorite, as long as it's of a self-directed nature. You're set up and you're ready to go. You have $0 in that account, but at least you've provided yourself that conduit to the market, okay? That drop point for the money that's going to accept those dollars and allow you to invest those dollars and seek your exposure to the stock market. The next thing that you're going to want to determine is what type of investor you want to be, okay? And this is one of those things that I've broken down into two categories. Now, you can be one and you can be the other, and you can be a mix of both, okay? Which really does introduce an infinite number of combinations, but we break it down in these two categories to let a beginning investor understand what their options are, okay? Make no mistake about it. When you seek your exposure to the stock market, you're going to buy a handful of different products on the market. The first and most obvious is single stock. You'll buy one share of an ownership stake in a company like an Apple or a Wells Fargo or a Disney or a JP Morgan down the line, okay, 3M. That's your single stock exposure. It does require a lot higher risk tolerance in my perspective. So for new investors, a lot of new investors will look to opt for a passive profile, which will come in the way of ETFs, mutual funds, index funds. Those three products, the index funds and the mutual funds, are actually very similar in nature. Index funds are passively managed. I am a very big proponent of ETFs. I do my investing exclusively through ETFs. I love the no minimum entry barrier. I love the passive nature, and I love the almost anemic to no fee expense over owning those wonderful products, okay? VOO is just one of the many examples that we talk about from Vanguard, and there are many others out there to which you can seek your exposure to as a passive investor. So the products, really, there's not an infinite number of products out there per se, okay? You either need to understand whether or not you want to be more of an active investor and hold some of those more aggressive assets like single stock, for example, or maybe you just want to be a passive investor and you want to put that money away in a diversified manner that's going to pay you the dividends that we all seek. It's going to provide you that compounding that we seek on both ends of the spectrum. And it's going to work for you, and it's going to be a lot more hands-off. So active or passive is really the easiest way that I can explain the two investor profiles for new investors when they're looking to take any sum of money and put that to work in the stock market. Now keep this in mind. The question that I got is, Ryan, how do I invest $80,000? Okay, when I look at the amount of $80,000, it's amazing how I look at it in different chunks. Okay, $80,000 to me is 4 chunks of $20,000. That's what I look at. So I chunk it up in chunks of 25%, and you can do this with any amount of money. Any amount of money you can cut up into quadrants, and then you can say, okay, well, now I'm looking at little increments of this 80,000, and maybe, you know, it's safe to acknowledge that the market at this all-time high, maybe an individual investor determines that because they're so young, they can just expose all of that to risk now and not worry about it. That can work. As long as the risk tolerance is determined such that if we do get a correction in the market, that the investor is going to hold true on those investments over over the long term. Now, if the age is such to where a little bit more wealth preservation is in line and a little bit more wealth conservation, because the investor is a little bit older and they're looking to expose some of that money to risk, but not all of it, maybe consider taking a $20,000 block and putting it to cash and building that cash buffer. What I'm not provided in this exercise is how much cash is being put aside, how much is being put aside perhaps maybe in an employer-sponsored 401k, 403b, 457, a plan like that that can help maybe guide the individual investor on how much risk they can take in another account. So that's super important to understand those particulars. But if you look at that $80,000 in those chunks and say, wow, I really don't have a lot of savings, you're right, I want to take 20 or even 50% of that money and put 40,000 of it away. Now we're working with $40,000. If you are in fact eligible for the Roth IRA, your maximum contributions are still eligible for 2019 going into 2020 up until the tax deadline of April 15th, okay? So there's eligible contributions from last year sitting on the table. If those have not been had, then you can soak that up with a $6,000, and then come January 1, you'll have the opportunity to take another $6,000 and introduce that. So you're talking about $12,000 of tax protected money. Now, if you desire to invest more than the $12,000, which I would consider that a very healthy start, and also justify being able to take that money, put that $12,000 away, and put yourself in a decision at the end of 2020 to not only contribute the additional $6,000, but to also be able to have that payment guaranteed in the cash pillar that you've already justified putting away, right? So you can kind of see how I deliberate taking that $80,000 and basically cutting it up into quadrants. That's how I like to do it. I really like to take it and divvy it up into quarters. If we were dealing with 100,000, we would be dealing with blocks or installments of 25,000 and so on. It doesn't matter the sum of money. That's how I deliberate when we're looking at answering those preliminary questions. How is the debt? How is the savings amount? How is the risk tolerance? What are the financial goals? What do you want out of the money? Do you have somewhat of an idea of what investable asset you are seeking out? What if you want to invest some in precious metals? See, I don't know that. So you might want to take a few of those $1,000 and start yourself with a precious metals aspect of this portfolio. But for example's sake, this really does drive home the point of the deliberation that someone should go through, whether or not they're looking to invest $1,000 or $100,000, okay? But back to the $80,000 example, we're really ready to start doing some research. The investor has determined whether or not they want to be an active profile or a passive profile. Now, the passive profile products are, like I said, the mutual funds, which I'm not a fan of. Index funds next, and then my favorite, which is ETFs, okay? We provide those outlets to go on to the Vanguards. If you like iShares, you can go check out those products. I just really like the ease and flexibility of entering into those. You're buying instant diversification at an extremely low cost to entry and very, very beneficial if in fact you're willing to stay the course over the long term as a passive investor. The active profile is such where you're entering into the best quality blue chip companies, dividend aristocrats, okay? All those stocks are ones that are deliberated on in the YouTube community very, very frequently. A lot of beginning investors are going to recognize a lot of these great names: McDonald's, Home Depot, Lowe's, you're talking JP Morgan, Bank of America, Apple Computers, Microsoft, Cisco, and the list goes on and on and on. So as a new investor, it absolutely benefits you to just take some awareness stake into what some of those great companies that exist out there are. Now, a lot of people come to me and they're like, I really like the ETF idea, Ryan, but I really like the idea of perhaps maybe accelerating and setting myself up for a dividend growth opportunity, maybe even some growth. Now, those opportunities are sought on the single stock side. So the beauty is when we look at defining each of these investor profiles, either active or passive, and you determine whether or not you want to be one or the other or a mix of the two, okay? I am a mix of the two. I have about a 75-25 split in my equities portfolio. Now keep in mind, my portfolio in and of itself is held in multiple buckets, okay? But in my equities portfolio, it's right on the head at about 25% passive ETFs and 75% stock. And that gives an individual investor the opportunity to look at it and say, you know, that's a little bit too aggressive for me. Maybe I want to do a 50-50 blend, or maybe I want to do a 75% passive because I don't trust my stock picking skills. Maybe I do a 75 passive and a 25% with some of those good quality single stocks that I know will set me up for maybe some wealth down the line, or even some generational wealth, okay? So maybe some Pfizer, some Microsoft, 3M, Home Depot, Boeing, okay, some of those great blue chips that we always talk about. And that's where the deliberation really starts to get fun, is when we're looking at a 75-25 blend, we come back to the blocks of that $80,000 that we've chunked up. And if we've taken the $20,000 and we've put that into savings, no problem. We've got $60,000 of white meat to work with, right? So we've got the $20,000, that's a cash pillar, a buffer. That is a luxury, guys, to put aside for yourself and go ahead and justify in accordance with the risk tolerance and the financial goals that you've set up, the remaining $60,000 into that account. Now, whether or not you're eligible to take the $12,000 and go into the tax-deferred account, the IRA that we talked about, or you're looking to do the $12,000 in the IRA plus start an additional taxable account on top of that, there's your option. Perhaps maybe you do the passive in the IRA with that $12,000, because now we're playing with what is allotted to us. What I mean by that is in the Roth IRA, you're going to be able to do 6 and 6, 12, right? So $12,000 right there in a tax-deferred account. So that's what you have to work with. Now we can further deliberate on what assets we buy with that $12,000, but I think a lot of people struggle with the fundamental breaking down that money to say 20 to cash, 12 to the individual retirement account, a little bit additional here. I'd like to start a little bit of a bond account based on my age and my investment goals, and maybe I want to start a taxable account on top of that and start some dividend income, right? So that's how we take an amount of money like $80,000. And when I get hit with this question, I would consider you guys, I would really encourage each and every one of you guys that the deliberation that I just walked you through, get it in the back of your mind that this is the exact same page out of my playbook that I go through, not only for myself, but for my family and for people who ask me, hey, how is it that I can invest any sum of money in the market? And I think you'll find that a lot of that conversation initially is aimed at, what stocks do I buy? And that is absolutely not the preliminary thing that you should be talking about, but it's actually the last thing that you should actually be talking about after going through that deliberation that I just walked you guys through. Thank you so much for tuning into the message, guys. Leave the comments at the bottom if I've missed something on this, how to invest $80,000 in the stock market. Really hope you guys appreciate the message, and good luck in your investment future.